Lecture 10. The Mysterious Money Market.
A lot of people say that the financial markets are just an exclusive club for the wealthy to make themselves rich at everyone else's expense. I don't agree with that opinion, and I hope you're starting to see for yourself why it's not true. But even I have to admit that the money market seems tailor-made by conspiracy theorists. The money market is exclusive. You and I can only participate in a part of it and are completely shut out of the rest. And it's hard to tell what actually goes on in the money market if you judge by the names of the instruments. For example, two of the most important money market instruments are commercial paper and repos. What do those names mean? Even the name of this market itself, the money market, seems misleading. It's not really a market for money, is it? Well, I hate to ruin a good conspiracy theory, but what actually happens in the money markets is just good old-fashioned borrowing and lending. Even though there aren't any secret societies trying to run the world from the money market, this is still a very interesting part of the financial landscape. Once you see how this market works, you'll understand why it's only open to the big players. And you'll see why the big players have come to depend on the money market, so that what happens there has a big impact on the rest of the financial market. Chances are you've probably heard the name money market used as a part of the term money market fund. Traditionally, the money market is the name we use to denote the markets for all financial instruments with up to 1 year of maturity. So a money market fund is an investment fund that only invests in financial instruments that have 1 year or less until they mature. Instruments with longer than 1 year of maturity are said to belong to the capital market. So the borrowing tools that we've learned about stocks and bonds are generally thought to be part of the capital markets, except for those bonds with maturity of 1 year or less. So when people talk about the money market or the capital market, they're simply distinguishing between instruments with short and long maturity. That 1 year of maturity seems like a pretty arbitrary cutoff. What difference does it make? If most money market instruments had maturity of close to 1 year, or say 10 or 11 months, then I'm sure this distinction wouldn't be very useful. But the vast majority of money market instruments have maturities that are much shorter than 1 year, and in fact, a huge part of the money market has overnight maturity, or just a few days. There's an amazing amount of borrowing and lending going on in the financial markets overnight, every night. When the maturity of the loan is 1 day, or up to a couple of weeks, it completely changes the lending game as we've been talking about it so far. Let's see why this is the case. First, think about the borrower's side. Do borrowers really need to borrow money only for 1 day? Well, I'm sure a handful do, but everyone else probably needs to borrow money for weeks, months, probably years. So why borrow money overnight if you need, say, 5 years worth of financing? Well, it must be cheaper for the borrower somehow. That's a big part of the answer. In general, the shorter the maturity of a loan, the lower the interest rate charged on the loan. For example, if lenders are charging an annual rate of 7% on a 5-year loan, then maybe they're charging an annual rate of 4% on a 1-year loan and an annual rate of 3% for an overnight loan. This leads to a great way for a borrower to save money on interest if he or she can pull it off. Instead of borrowing for 5 years at the 5-year interest rate of 7%, if they borrowed overnight at the overnight interest rate of 3% annually and simply kept borrowing at that lower rate, then they'll save a huge amount of interest. But who can keep borrowing overnight like that? Well, high-quality borrowers, that's who. There are borrowers out there who are so financially strong and responsible that it's almost certain that they'll pay back their overnight loans every single morning. These are borrowers like governments, big banks, and blue-chip firms. For example, people line up to lend money to the McDonald's Corporation because their earnings from selling hamburgers all over the world are so dependable. If you're going to be borrowing overnight virtually every day, then speed is of the essence when it comes to being able to issue securities. You need to be able to issue securities the same day you decide to borrow. Remember though, most securities need to be registered, and registration can take a long time. It always takes more than a day. So money market instruments are designed to take advantage of exceptions to the SEC rules that require securities to be registered. There are special exemptions from registration for several different kinds of publicly traded money market instruments. I'll mention one of them in a few minutes. For other types of money market instruments, there's a special type of registration that's called shelf registration. Shelf registration allows an issuer to register a large amount of securities at one time and have up to several years to actually issue them. The name shelf registration comes from the idea that a borrower will pre-register a big pile of bonds and then place them on a shelf in the office. They take some securities off the shelf, so to speak, and issue them to the markets whenever they need money. The other part of issuance that needs to be speedy is the actual sale of securities. If a company needs to borrow overnight, it needs to be able to sell the securities it issues right away. If the company issues lots of small bonds to many investors, then it may take a long time to line up all these small investors and get them to purchase the security. So issuers of money market securities, with one notable exception, only issue securities in big chunks so that they need to find far fewer willing lenders. For most money market securities, that minimum denomination is $1 million. That's the main reason why most individuals are shut out of the money market. Most of us don't have $1 million to invest, let alone in a single bond. And though most of us would probably like to be able to borrow $1 million at a time, it's unlikely that most of us could find a lender willing to lend us that much, at least without some serious collateral. Speaking of collateral, an interesting feature of many money market instruments is that they're unsecured. The borrower doesn't post any collateral. Lending millions at a time without collateral. That sounds pretty dicey. How can that work? Well, let's think about money market lending from the perspective of the lender to figure out why. The money market borrower is borrowing overnight or for a short period. The chances are that when the security matures, the borrower will come back to the lender and want to borrow again. That is, the borrower will want to sell the lender another money market security. This means that the borrower will probably borrow over and over again from the same lenders over a period of years or even decades. We call this process in which a borrower pays off a maturing loan by immediately borrowing again from the same lender, rolling over a loan. So in the money market, most borrowers intend to roll over the securities they issue many, many times. This repetition, or repeated game as the economists like to call it, gives the lender extra leverage over the borrower. If I'm a lender and I know that you'll need to roll over your securities time and again, then I can get you to behave by threatening to stop lending to you and leaving you high and dry. Economists call this the rollover threat. It's very serious in the money market. If the borrower misbehaves even once, they'll lose access to this short-term funding and will have to scramble to replace it with longer-term borrowing. This extra power that lenders have because of the rollover threat means that they don't have to rely on collateral to protect themselves from the risk of default, or the other information problems that we've learned about in this course. In my own research, I've called this phenomenon the maturity collateral compromise. This is another one of the fundamental compromises that helps distinguish different financial instruments from each other. You may remember that we learned about another fundamental compromise called the seniority control compromise in the lecture about stocks. The maturity collateral compromise says that borrowers and lenders agree to trade off maturity against collateral whenever they negotiate financial lending contracts. Longer maturity loans generally have more collateral, and shorter maturity loans use less collateral or even no collateral. An additional reason why lenders in the money market don't insist on collateral is because they're extremely picky about who they lend to in the first place. As I mentioned a couple of minutes ago, the money market borrowers need to be financially strong, but that isn't enough. The money market borrowers also have to have an excellent reputation for being good borrowers. In other words, even if a company has great financials, this may not be enough to enable them to borrow in the money market. They have to have a great reputation as well. In fact, Economists believe that in the money market, these borrowers are using their reputations as a substitute for collateral. Economists even call this reputational collateral. Reputational collateral is a great asset to have, but it's fragile. If a money market borrower misbehaves and damages the reputation for repayment, then they'll be shut out of the money market for as long as it takes to rebuild the reputation, and that can be a very long time. Now we understand how and why the money market differs from the capital market. But I'm guessing that you're still puzzling over the name. Why is it the money market? Well, that has to do with the very short maturity that we've been learning about. Money, cash that is, has zero maturity. And because money market instruments have very short maturity, they're considered to be close to cash or close to money because they'll mature and convert back to cash very soon when the borrower pays back the loans. Of course, we've learned that most borrowers and lenders keep rolling over the money market securities. But the lenders always have the option to say, "Enough, I want my money back this time." In addition, holders of money market instruments are usually able to sell these instruments for cash quickly and easily because there are so many eager lenders for these securities. We say that the money market is a very liquid market. Here's one of the main reasons why there are so many money market lenders. Lots of big companies have extra cash that they won't need for a few days or a few weeks. Money market instruments are a great place to store extra cash for short periods of time, where it can earn some interest. Most large companies have cash management programs in which they forecast their needs for actual cash over the short term and then park their extra cash in interest-bearing securities, usually money market securities. If they forecast a cash shortfall, then they can borrow in the money market too. Another big source of demand for money market securities is from money market mutual funds, also known as money market funds for short. Money market mutual funds are special investment companies that take customers' deposits and then invest these deposits in money market securities. This is one of the two main ways that individuals participate in the money market. Money market mutual funds have been around since the 1970s, and for many investors, they provide a higher return alternative to bank deposit accounts. That's simply because for the investors, money market mutual funds look like and work like bank deposit accounts. If you'd like to learn more about the details of money market mutual funds, I cover them in detail in my course, Understanding Investments. I've been talking about the money market and money market mutual funds without talking about specific money market instruments. So what are these securities? There are quite a few, but I'm going to introduce three of the most important ones. We'll start with short-term government bonds. In the US, they're known as Treasury bills, or T-bills for short. Most major governments' bonds have special nicknames, by the way. US government bonds are known collectively as Treasuries because they're issued by the US Treasury. Short-term German government bonds are called Bundesschätzen, or just BU-bills for short. And Japanese government bonds generally go by their initials, JGBs. The word bill in the name denotes a bond with up to 1 year of maturity. So if a security has the word bill in its name, we automatically know that it's a money market instrument. For example, another money market instrument with bill in its name is a bill of exchange. So the name T-bill automatically denotes a US government bond of up to 1 year of maturity. And again, the T in T-bill is short for Treasury. Short-term government bonds are generally issued for maturities of 3 months, sometimes 6 months, and 1 year. Governments like to stick to standard maturities for two reasons. First, they generally don't want to have to go back to the market to borrow as frequently as businesses do. Even so, large governments do issue their short-term bonds quite frequently. New T-bills, for example, are issued once a week, every week. The second reason why governments stick to standard maturities is in order to create an orderly and liquid market for their securities. Governments want to make it easy and attractive to buy, hold, and sell their securities. That keeps their borrowing costs as low as possible, and it helps ensure that when the government borrows in the credit markets, it affects private borrowing and lending as little as possible. So most governments around the world have standardized the maturities of the securities they offer, and they've committed themselves to a schedule of selling bills and other bonds that's dependable. The amounts that the governments intend to borrow are also announced in advance, to give the markets enough time to get ready to absorb the latest issue of government bonds. This process of standardizing maturities, committing to a sales schedule, and announcing the size of issues in advance is called regularization, and it was pioneered by the U.S. Treasury back in the 1970s. Before then, government bond issues were more ad hoc, and occasionally they surprised the markets in a bad way. Most governments issue quite a large amount of short-term government bonds like T-bills. This is a very flexible way to finance the government. Remember, we've learned that even if a government takes in more taxes and other revenues than it spends, it's still likely that there are frequent mismatches between receipts and expenditures, given their seasonal nature. So instruments like T-bills are perfect for handling these short-lived borrowing needs. And governments that do need long-term financing can roll over their short-term government bonds just like business borrowers do, thus creating long-term financing out of short-term instruments. And lenders, generally speaking, are happy to invest in short-term government bonds. In many countries, government bonds are considered a risk-free investment, and so the interest rate the government pays on T-bills is considered to be a risk-free, short-term interest rate. So when people in the markets talk about a risk-free interest rate, they usually mean the interest rate on a government bond. Now, when people say that government bonds are risk-free, they generally mean that government bonds are free from default risk. This is because governments have the power to raise taxes in order to get money to pay back their debts. And if all else fails, they also have the power to print money to pay their bills, though that's generally an act of desperation. So a government can almost always pay back its debts as long as it can tax or print money to pay back the debt. This helps explain why governments can borrow without collateral, or at least without having to pledge explicit collateral. The power to tax or print money really functions like implicit collateral, sort of like the reputational collateral that we've discussed. Even if we assume that there's no default risk in government bonds, there can be other risks, and inflation is one big risk that comes to mind. Many government bonds do not protect investors against inflation. Now, this can be a serious risk for investors in long-term government bonds. For a 3-month T-bill, inflation is much less of a risk, but it can still get significant if inflation gets out of control. Some governments do issue inflation-protected bonds called inflation-indexed bonds, in addition to regular government bonds that don't protect against inflation. Now, because government bonds are considered risk-free, they offer a very safe place to invest money. That makes T-bills very popular with all kinds of investors, including individuals. The government issues T-bills and all other government bonds, by the way, in denominations as small as $1,000. This is another one of the few places where individuals can participate directly in the money market by joining all the other investors in short-term government bonds. Now, I realize that in some countries, the government may not necessarily be considered a great borrower, even by its own citizens, especially if the government is just getting its own start in issuing securities. For example, governments in many developing countries only borrowed from banks, just like the businesses in these countries do. But over the years, many governments have tried to introduce government securities as a way to diversify their credit and provide saving instruments for the public. In cases like this, the first kind of government security that appears is a short-term government bill. Investors are willing to buy a money market security from the government because of the short maturity. There's less of a chance that something would go wrong that would prevent the government from paying back the security, and the rollover threat can be just as effective on governments as it is on private borrowers. Another reason short-term government bills are such important financial instruments is because they provide a reference point or benchmark for most of the borrowing rates in the economy. Because government bonds are usually considered risk-free, the interest rate on government bonds will be lower than the interest rates that private borrowers, who are at least a little more risky than governments, will have to pay on their loans. Second, as I mentioned, longer maturity bonds will tend to have higher interest rates than shorter maturity bonds in general. So the interest rate on a 3-month T-bill is one of the key benchmark interest rates in the economy. This rate is effectively a lower limit on most of the market interest rates that are relevant to our lives. Well, let's move on to the second of our 3 money market securities, commercial paper. As I mentioned at the start of this lecture, the name doesn't tell us all that much. It's just a kind of an old-fashioned name. The commercial in commercial paper, or CP as it's frequently called in the markets, denotes that it's used by businesses. The term paper is an old-fashioned term for a bond. Commercial paper simply denotes a bond issued by a business. But while that description is generally correct, commercial paper has a much more specific definition. Commercial paper is unsecured company debt with maturity of 1 to 270 days. Note that the debt is unsecured. There's no collateral. That's that maturity collateral compromise at work. The maturity seems a little strange, only up to 270 days, or about 9 months. That's because of SEC regulations regarding registration exemptions, which we also discussed. The SEC allows corporate debt of 1 to 270 days of maturity to be exempt from registration if the debt is used to fund the day-to-day operations of the company. The vast majority of commercial paper is designed to take advantage of this exemption. Commercial paper has been around for a couple hundred years, but it really came into its own as a funding source in the 1970s. Lots of companies wanted to issue commercial paper because of the low interest rate and the flexible nature of the debt. But there just weren't enough interested lenders in the market, so the size of the total market was limited. But in the 1970s, a new type of financial intermediary was created, the money market mutual fund. Money market mutual funds were created to provide a type of deposit account that wasn't in a bank and therefore wasn't subject to government limits on bank deposit rates, which remained in effect until the 1980s. The managers of money market mutual funds started to buy up as much commercial paper as they could because the securities were very safe and they paid a higher interest rate than T-bills. Because of commercial paper, the money market mutual funds could offer interest rates that were much higher than bank deposit rates at the time. Because of money market mutual funds, the commercial paper market suddenly took off. The number of willing lenders matched or exceeded the number of willing borrowers. In fact, the demand for money market mutual funds was so great that some companies were able to dramatically expand their commercial paper borrowings. One special type of company that took advantage of the growth in the commercial paper market was a financial intermediary called a finance company. A finance company makes loans just like a bank does. But instead of funding itself by issuing deposits, a finance company has to borrow in the credit markets by issuing securities. Some of the largest finance companies have been affiliated with car companies, such as Ford Motor Credit, or with other manufacturers, such as GE Capital. These finance companies borrow on the credit market in order to, say, make a car loan to someone buying a new Ford, or an installment loan to someone buying a new washer and dryer. Finance companies benefited tremendously from the expansion of the commercial paper market, since they could tap into a huge source of very cheap financing. In fact, because of commercial paper, finance companies were really doing the same basic things that a bank does, borrowing short-term and lending long-term. It's just that the finance companies were borrowing via commercial paper instead of taking deposits. The commercial paper issued by finance companies would go to the money market mutual funds, which were held by the same people who also held bank deposits. So the creation of money market mutual funds led to the expansion of the commercial paper market, which in turn led to more intense competition between banks and finance companies. Finance companies weren't the only ones who benefited from the expansion of the commercial paper market. Many large non-financial corporations started to issue commercial paper as a normal part of their funding mix, and over time became dependent on this market to supply the cash they needed to support their operations. And with the exception of an across-the-board financial market panic in late 2008, which wasn't caused by commercial paper, by the way, this system has worked very well. Companies have quick access to funding at low interest rates, and investors have a higher-yielding alternative to bank deposits. There's one more money market security that I want to tell you about, both because it's very different from the usual money market instruments and because it's become extremely important to business borrowers. This instrument is called repo for short, but its full name is a repurchase agreement. Here's how it works. Suppose I'm holding a 10-year U.S. Treasury security that's worth, say, $10,000. You and I make an agreement that I'll sell you the Treasury bond today for, say, $9,500. And at the same time, I agree to buy back, repurchase, this bond tomorrow for a price of $9,510. Now, why in the world would you and I agree to do that? Well, think about what just happened. I get to use $9,500 overnight, and then I pay you back plus $10 tomorrow. So one way to think about what's just happened is that you've loaned me $9,500 overnight. That extra $10 that I pay you tomorrow is just the interest on the loan. So a repurchase agreement is simply a short-term loan. And notice that it's a very safe loan. First, it's collateralized by the Treasury bond. I transfer the Treasury bond to you overnight, and you hold it until I pay you back. If I can't pay you back tomorrow, you get to keep the bond, even without having to go to bankruptcy court. Second, notice that the Treasury bond is worth $10,000, but you'll only loan me $9,500. That way, you have extra protection against changes in the value of the Treasury bond, and I have extra incentive to pay you back on time. By the way, the practice of lending me less than the full value of my collateral is called giving the collateral a haircut. It's a standard practice in the financial markets whenever people post collateral, especially in the form of securities. Well, you can see why repurchase agreements, or repo, are different from other money market instruments. Repo is collateralized, whereas most other money market instruments aren't. Remember that only the most creditworthy companies can actually issue unsecured money market instruments like commercial paper. The repo market, on the other hand, is available to any business that has Treasury securities in its possession. And that helps explain why the repo market is as huge and important as the commercial paper market. Just about any business can lend or borrow using repo. At any given time, there's about $1 trillion that have been loaned out in the US using repurchase agreements. Another aspect of repo that explains its popularity is its safety. It's almost as safe as the Treasury bonds that form the collateral. And finally, the repo market isn't just for overnight loans. If a business is sitting on a big pile of treasuries that it isn't going to need anytime soon, it can enter repo agreements for weeks at a time, or even open-ended repo agreements that have a flexible ending date. In fact, as part of the cash management plans that I mentioned earlier in this lecture, businesses will deposit their government bonds with a bank who will look after the bonds for the company and arrange repo loans for the company as often as and for as long as the company needs them. Because this arrangement brings a third party into the repo transaction, which is the bank that looks after the bonds and does all the admin work, it's often called tri-party repo. Well, that completes our look at the money market. This market is almost invisible to most people and yet forms the financial lifeblood of governments, large banks, and corporations. Instruments like T-bills, commercial paper, and repo keep a tremendous amount of money moving through the economy. And remember that the movement of money through the financial markets keeps the entire economy healthy and growing. Now that we've learned about the money market, we've seen just about all the major ways that borrowing and lending take place in financial markets. But there's still one more useful dimension of borrowing and lending to learn about: the international angle. We've been learning about borrowing and lending as if all of it takes place locally, or at least in the same country. But international borrowing and lending is also a big story in the financial markets, and has been ever since banks and securities have existed. If we want to feel as comfortable in the financial markets as we do in the grocery store, we need to understand why people lend to overseas borrowers and how that process works. Borrowing and lending internationally gets a bit more complicated or more interesting depending on your perspective for many reasons. One of the biggest reasons is that different countries use different national currencies. Next, we'll not only learn about borrowing and lending across borders, but we'll also learn about one of the most surprising financial markets out there, the foreign exchange market. This lecture will serve as a good transition from our unit on borrowing and lending to a unit that explores one of the other main activities in the financial markets: trading. Make sure your passport's up to date, because the next lecture, we're going abroad.